And the first thing that we want to talk about a little bit is just market prices. So let's go through, do people trust market prices? If they do, give some examples there, and then maybe we just riff back and forth a little bit.
Absolutely. That's a question, we get, maybe not that specific question, but we get different versions of it. Basically, that's the question being asked. Hey, I heard this news about this company. Should I go buy the stock now? Or, this I think is about to happen. I heard this on the news. That might affect this company this way. Should I buy or sell that stock of that company? One analogy I like to go back to, because it's just really simple, is the grocery store. When you think about when you're driving to the grocery store and going to buy groceries, what does that look like? Are you driving to 12 different grocery stores in town, trying to find the absolute best grocery store to buy apples at? Are you trying to predict the weather and the growing conditions for the apple harvest this year and try to get some information that maybe the grocery store doesn't have about apples, future prices, so you can kind of plan your apple buying accordingly? Like, no, you kind of understand that the grocery store is in a competitive environment with other grocery stores. They're pricing competitively, and that they probably know a lot about apples. It's their business to know a whole lot about apples. So you trust those prices when you go to the grocery store. And there's sometimes a temptation in the stock market to not trust the prices, but it doesn't make any sense, right? Kind of a fun stat we have is, every day over 50 million shares of the company Apple. Do you get the pun here that I'm going for? The company Apple, over 50 million shares every day are traded. And that's way more apples, way more than actual apples are sold every day in grocery stores. And so you just think of something like that. There's tons of professionals every single day buying and selling this stock with really good information about the future prospects for the company. It's going to be really, really hard for any individual to know better than the market price on that particular day for that stock. Now, that might make you wonder, okay, like, what's the point of asset allocation? And we're going to get into that later. But the point here is that at any given time, in most competitive markets, the price for something is probably the reasonable price to pay for it at that point in time. Now, in the future, you may expect different rates of returns for different assets over time, but the actual price on that day is usually fairly priced, and trying to outguess a bunch of other professionals in the market is a really, really difficult way to try to make money in the investment world, and something you should probably stay away from.
Well, yeah, and it's not something you do in the grocery store. Okay, On the asset allocation, I'm going a little off script here already, but in this format, that's what we're going to do. So as you were talking, I just had this thought of you mentioned asset allocation, but when you were talking about apples at the grocery store, I also had this thought about gasoline prices. And if apples are expensive, I don't decide, okay, I'm going to buy less apples today, and I'm going to go load up on gasoline because I think it's a little cheaper than it should be. The same can kind of be said for asset allocation. Is like, well, you have to make sure you actually need that before you decide to buy the other thing, right? Because apples and gasoline are two very different things. You don't get much nourishment from eating or drinking gasoline, right? Yeah. So does my portfolio actually need this? And then the question is it fairly priced? Which is maybe a question the everyday investor, shouldn't really even be asking, because the market's efficient and usually gets it right. But do I actually need this? Is it fairly priced? And then, okay, where can I supplement that part of my portfolio? But I have to make sure that I have the right amount of apples before I look at anything else. So I think really in this example, like, that is some asset allocation, is making sure that's what I need in my portfolio, instead of worrying about, is it fairly priced, or am I getting a discount today, or can I find it better on this exchange?
Absolutely. I mean, this goes into a lot of the work you always do with clients, of like, it starts with a plan, and from the plan you might get some goals. The goals will in turn determine the investment strategy. The investment strategy will determine sort of the allocation. And then once we have an idea of the allocation, then we go look at the funds.
That's it.
And the products. So it's like, if you're, first the apple, just to extend that metaphor as far as we can, first you decide, okay, my kid is hungry. I'm going to make them lunch. And I'm going to make them a sandwich plus a side. I want that side to be healthy. I want it to be fruit. I'm going to go buy an apple. You don't start at the grocery store and think like, I don't know, that's a cheap apple. Do I need apples today? Do I not? You start with a goal in mind, and then you work your way down to the product.
Hey, thanks everyone for watching. If you enjoyed this video, feel free to click the link below to watch it in its entirety. We appreciate it, and we'll see you next time.